To moderate this panel is none other than Ali Twaha. Ali Twaha is a senior journalist at the Vision Group. I believe an award-winning senior journalist. I'll invite Ali Twaha to step on board and welcome his panel. A round of applause to Ali.
Good afternoon. Gen Z's good afternoon. Yes, this panel was supposed to start at 3:20 and end at 4:40, but when I look at the clock, it seems we are run out of time. I want to thank the organizers of this event, CFA Society, and to thank them also for inviting me to moderate this session. And like Sanya said, this panel will look at the exit options, policy, and tax reforms for a vibrant private market. So without wasting much time, let me invite Mr. Paul Bwiso from the USE, is the CEO. You may take your seat. Round of applause, please. I want to invite David. David is the investment director at PCP, which is Pearl Capital. David, please. We have Tusabe John, is the director tax advisory at BDO East Africa. Let me also invite Abubaker Mayanja, who is the financial and strategic business services at UIA, please. And finally, let me invite the regulator, Mr. Dickson Ssembuya, to the panel. He's the Director, Research and Market Development at the CMA. I feel like it was a sort of a big disservice to give this panel this, to give them this little time on the entire program. But let us proceed. Earlier on, I was speaking to Luetabe, and I was telling him every time I have to meet CFA people, I go through a lot of challenges because of the language they use. Sometimes as a journalist, I want you to speak to me as Omuntu wa wansi, and I would want to beg the panel to, tone down on the jargon so that you speak to the Muntu wa wansi who you would want to appreciate some of these discussions. So to start us off is, so I just want to assure you that all the panel members have more than 10 years of experience about what they're going to talk about. So if you doubt, you can verify. You can go on the CFO website and just follow, they've put the profiles. You can go and just look at their CVs on the LinkedIn. Very quickly, I want to invite David to speak about the environment that the private market is in currently. When I went on his LinkedIn, on his about, he says that, and I quote, "My long-term goal remains to be an expert on deploying and managing capital in the private space for fastest growing businesses." So that comment alone shows the commitment that he has to see this market work. So David, I want you to tell us, over more than the past 12 years that you've been in this market, what are some of those issues that that touch you and you would want Paul and Dickson to really focus on? Just kick off this discussion with that brief background on what's happening. Thank you.
Thank you, Mr. Twaha, Ali. Going to the topic of the subject, exit policy and tax reforms for the private market. We had a morning session where we discussed where the private market is, and we ably managed to identify or define that. But speaking specifically to this topic about exit and reforms on regulation and policy, the private market in Uganda over the last 11 years has attracted $2.3 billion in private equity investment. That is about 200 million a year. And it has done deals in each year of an average of 30 million, given the deal count. And those deals had a range of about 5 to 70 million. So it gives you the continuum of, or the spectrum of the deals. So deals in energy, manufacturing, financial services, ICT, that gives you the spectrum, health, and that kind of thing, agriculture. Those have been the areas of attraction in Uganda. These deals have largely been financed by development finance institutions in Uganda, and very little has been financed by way of private or local capital, with very insignificant local capital coming into the private market. So it's the DFIs that have actually developed the private market in Uganda. And they have domiciled their funds outside Uganda, which has real implications on domestic capital attraction and capital sitting into this market. The reason being that we have had and still have, maybe until the budget speech is read with the proposals therein, a very inefficient private market for capital to sit here. Inefficient in the way that it is tax inefficient. I won't go through the math, but when you look at the vehicles that deploy capital as funds and as investees and as investors, the tax implication across those three persons, and my colleague Jet will speak to this, from withholding tax, income tax, capital gains tax, etc., represents almost an effective tax rate of 65% on returns to investors. There is no one who's going to invest $1 and earn 35 or 35% of it if it comes back in return and take 35 because of tax, an inefficiency called tax. And that inefficiency is because we are taxing everyone as a separate individual. We are taxing the fund, we're taxing the investment that was made, we're also taxing the investors because the URA ones collect tax from everyone. And as ably said by the tax director from PKF, that then means we are overtaxing the existing tax payers by finding all means to destroy value from their earnings, whether it is taxing them at the purchase of the good, taxing them at the income, taxing them at withdrawing the money from the bank. You just find a way to tax and out-tax. So that framework has meant that we have not had funds domiciled here, and that has a big implication on private capital formation. Notwithstanding alone, one, we don't have skills in this market because we believe that all these funds should be in Mauritius where they are administered. And when you meet the Mauritius guys, quite sharp guys, you know, they can articulate anything. One Mauritian guy to me can represent 5 Ugandans. You know, he can do this, that. But that's because they're exposed. It's a very small population, but it manages and does the administration for the entire global private equity market for Africa. You can't believe it. So why are those funds domiciled? So skills. 2, it also means that when capital decides to invest in Uganda, people don't have any traction as to what is happening. They ask for Excel sheets, which is a map, but they don't know the terrain. So by the time they make the decision and they deploy the capital is either lost or not well managed. And then we get a bad reputation as, you know, bad managers. And so it has a very negative long-term impact on our SMEs, our businesses, to attract attractive capital or patient and long-term capital to develop. And what is left is businesses going to loan sharks and commercial banks to attract finance for long-term financing. So this has been the climate. But that climate, we have communicated to government, brings in 200 million a year. If we have 200 million a year seated here, developing business over the long term, why are you taxing it across all layers? You tax it where it is making money. You tax it when it's going out. You tax it when it's being distributed. You want to tax everything, and then you leave investors with barely any return on their initial investment. So there's been discussion to make that efficient, and the regulators, I think, will speak to that. The policy guys and the tax people will address that, as the panel is, is quite heavy on that. But for me, the economics of domiciling local capital in Uganda has hitherto been uneconomic, viable because of the tax regime. The regulation can change in terms of definition of who a private equity fund is. That is pretty easy. But those inefficiencies from the economic side mean that I am unlikely to bring the capital here. I'm likely to take it to Kigali, where there is the Kigali International Finance Center, which is now domiciling capital that is investing across Africa. There is Mauritius, where capital is domiciled, where there are favorable regimes. There is South Africa, where there are favorable regimes. These are things we can do in Uganda. And I think the policymakers in the room are listening and have listened. And we hope that, we're going into the positive direction on the economics of the private capital business. Thank you.
Thank you, David. Let me bring in Jet when David's point is still hot regarding tax. This has been one of the biggest issues, the tax policy. I mean, you tax the vehicle, you tax the entrepreneur, you want to tax the corporation. It raises a bit of question, where should government focus the tax element when they're dealing with the market?
Thank you very much, Ali. I agree. It has been a huge pain for the sector or for the country. And it is unfortunate that it has gone on for a very long time. And for me, I want to thank the resilience of you guys, the Ugandans. How can you survive in that kind of environment? You're very resilient. So that said, that challenge, fortunately, thanks to the well-articulated propositions by the likes of David and also Dickson, CMA, together with tax advisors like myself, there have been a push to government to reconsider that problem. And Parliament, the President listened, the Minister of Finance listened, and as we speak, Parliament of Uganda passed the Income Tax Amendment Act, which reverses that problem, and also passed the Stamp Duty Amendment Act, which addresses the stamp duty issues around investments by private equity funds and venture capital funds. So, of course, whereas Parliament passed it, the President has to sign it for it to become law. So, members, don't quote me that Jet said the law
Anything
has.
can happen.
So Parliament passed it. It is on the Hansard, and chances are high that the President is going to sign it. When you look at the paperwork the David and team did for him and Parliament, there's no way he can say no. So at the moment, when you look at how the law has been designed to address the problem, it is saying, what has been your challenge? Your challenge has been you're taxing the investee when they make the money, the profits. You tax 30%. When the dividends are going to the investing vehicle, you tax withholding tax. When the funds get to the fund now, you also tax income tax. So that chain has been broken. What is going to happen going forward, effective 1st July 2024, this year, once the President has signed, what's going to happen is, one, when the investee is paying a dividend to the private equity fund or venture capital fund, which is regulated, which has been cleared by Dickson, then there will be no tax on the income streams. What are the income streams? Dividends, interest in case of debt. So meaning that that tax will not apply going forward. The same applies to when, now that's to the fund that has been registered here. Now, to make it more attractive to the investors, either locally or from abroad, to bring funds into the fund, government is saying even the investors will be exempted when they are taking out their cash flows. Shouldn't we clap for government for that, guys? Dickson, well done. So that means that the investors, local investors, will be encouraged to put funds into these PE or venture capital funds, or even foreign investors, because the chain has been broken, but on top of that, you will not be paying, the investor will be able to take out the funds tax-free. And that means that the cost of financing, which is one of the biggest problems, is going to go down. Because if you look at withholding tax on interest, it is 15%. And these debt financiers don't pay the tax, actually. They inbuilt it into the pricing such that the investee company is the one that bears the cost of that tax. So meaning that the cost of borrowing increases by 15% on top of the actual interest charge. So that, when the vehicles are investing through PE funds or venture capital funds, that's going to go away. So that's on the cash flows. But there's also at exit. So at exit, government is also saying that going forward, to attract or encourage funds to build locally or from foreign sources, the capital gains tax that is currently imposed at 30% is going to go away. And that, for me, has been one of the biggest challenges for PE and venture capital funds. And on top of that, they are saying that for you at the stage of entry, you bring funds into an investee company, you're acquiring, for example, you're acquiring equity, an equity stake into the investee, or you're bringing debt and their debt instruments which attract stamp duty, or this company needs to increase share capital so that can accommodate the new funds from the new investor. That stamp duty is going away. Similarly, at exit, when the fund decides to sell, there is also stamp duty on the transfer of shares in the present law of 1.5%. So that stamp duty is also going away. So in a nutshell, Ali, there's a lot of story around it, but there's good news from government this time round, that we have heard your cries and we are doing something about it. Thank you.
Well, thank you. You've preempted everything I wanted to throw at Dickson. But good job there. But let me bring in the regulator on issues around incentives, to the private market. In your speech earlier, you talked of the regulations on real estate trusts which are coming up. You also mentioned of developing regulations for limited partnerships, but give us a little bit more depth on you could give us timelines on some of these discussions that are going on, because last year we made a bit of similar promises. So just a bit more on your presentation.
Thank you, Ali. Good evening, everyone. Now, maybe before I get into the incentives, what I would like to start by doing is probably just providing a bit of background with respect to the private capital space. Now, if you look at the National Development Plan 3, NDP 3, which is part of the blueprints for transforming Uganda into a high-income, middle-income country, part of the actions therein is developing streams of alternative sources of financing for business with a focus on private capital markets. And the specifics therein lie, or the specifics with respect to that, around the legal regulatory framework and the taxation regime. And I'm glad to report that, after so many meetings and having discussions for almost 5 or 6 years, we're seeing some traction. I think we've had some very good partners in the name of IFA, PCP. David can attest to the number of times we've actually had to meet His Excellency the President just to explain how this works. And the beauty is that he really appreciated where we were coming from. Now, ideally, a private capital fund should be structured in such a way that it's a transparent vehicle when it comes to taxation. And one of the most suitable structures around that is the limited partnership structure. And if you look at what we're doing around that, we've looked at the Partnership Act, and we've identified a few gaps here and there. And so what we're trying to do is we're trying to plug in those gaps so that we can make domiciliation as attractive as possible. Now on the tax, discussion, there's good progress. But I think I was actually having a discussion with someone, and I think what I told them was, you see, the passage of those tax exemptions or that favorable tax regime is only the first step. And you actually realize, yes, it's something to celebrate about, but this is just the beginning. Okay, so we probably don't know much about what's going to happen after that. And so that speaks to the entire ecosystem. Okay, so that speaks to the entire ecosystem. Okay, so in terms of knowledge, do entrepreneurs know about these alternative source of funding? Skills, are we skilled enough to basically handle the private capital space? I think David talked about 5 Mauritians, one Mauritian handling the work of 5 Ugandans. I hope, yeah. But basically, there's still work to be done. There's still work to be done with respect to having this take off. Yes, we've had some few wins here and there, but then again, I think we're just at the beginning. Yes, the tax incentives that will work in terms of ensuring that investors are actually able to get a lot more in terms of what they deploy. On the regulatory bit, I think without being really preemptive, the regulatory framework that we envisage will actually have a very light touch. Regulatory approach. You're not likely to have anything prescriptive. You're likely to have principles and a few guidelines here and there, just to ensure that, yes, we know these are private markets and they don't put everything out in the public. Okay, so you need to appreciate that even as you're coming up with something to ensure that they're able to operate. So ensuring that you have a very light regulatory regime is actually part of the ways of being able to attract these funds. When it comes to regulatory compliance or the regulatory burden, you try as much as possible to lighten it so that you're able to incentivize them to actually deploy capital and get that registration or get that legal recognition. So in terms of incentives, yes, they might be a bit light for now, but I think we're still going to scratch our heads so that we try and get as many incentives as possible thrown towards the direction of the private capital space. I thank you.
Yes, thank you, Dickson. I wanted to report, is it Innocent? In the morning, was looking for USE and wondering why people are not exiting through the primary market. So I thought, but by that time, Paul was not in the room. So I just wanted to put this question to you. We have currently there are, capital providers who are stuck in transactions, and exit options are, there are not as many for them. So one of the avenues is through an IPO. I'm just wondering, do you have, incentives around that area that you're working on, to pull these capital providers through the IPO? Just a quick thought around that.
Thank you, Ali. Now, good afternoon or good evening, ladies and gentlemen. So, the exchange provides a platform that enables companies exit or raise capital. Now, the challenge I think we faced, especially around private equity companies, is that we have approached quite a number over the years. But usually they prefer to exit to other private equity funds. And our guidance has been that there are quite a number of benefits of the stock market if you exit through an IPO, initial public offer. Capital gains is exempt. Trading on the secondary market is capital gains exempt. So, and there are some allowances in the tax space that one would be able to take advantage of if you're a public company. I think the challenge is, the challenge comes out when a couple of issues. One, to what extent are these companies valued? Are they overvalued, and what are the investors looking for? Usually private equity funds drive a lot of growth, leverage these companies, and are able to change them from the basics to really high operating companies. Now, coming to the market means that you're trying to attract public funds. This is pension fund, retirement money that requires particular returns to the members of those funds, and even the general public. I'll use a specific example, and that will be Umeme, CDC, the British investment arm that invested in Umeme in 2005, but had a long-term plan of its tenure of that investment was 7 to 9 years. In 2012, they listed on the exchange, but when they started this investment, they deliberately set it up to be run as a public company, and the governance, the management structure was all developed around the exit through the public markets. And even when they came to market in 2012, their valuation was modest, with a further plan to exit along the way, and they exited again in part of the fund in 2014 and finally in 2016. So there was a deliberate aim to work towards an exit through the public markets. Now, most private equity funds or companies we go to that have private equity investors usually come at the tail end when the fund is coming to maturity, needs to exit, and yet we all know that there's a process in which you need to go through to become a public company. The legal structure, the tax structure, the way it's run, getting the governance straight, the disclosures, among others. So that work usually takes time, and we've not gotten the feel of these companies looking to put in that work, because their core objective is to drive growth of the company. And preparing for an IPO can be time consuming. So the conversations have been ongoing. We've continued to encourage companies to come, but I think that's been really the limitation, the timing of when these companies should come to market. Thank you.
Yes, thank you, Paul. The timing is tricky, but let me bring in Abubaker Mayanja from the UIA. I just wanted to know what you are doing as a government agency to ensure that a bigger portion of the private capital comes from the locals here. not from Dubai, not from London, not from UAE. I don't know. Just quick one on that.
Sorry, Mr. Panelist, I'm from a private firm, but I'll go ahead to answer the question.
All right.
So the fundamentals around getting more capital in the market come from the economic fundamentals. I know my panelists here are better practitioners than myself, so they've answered most of the questions. But the fundamentals of the GDP economic equation is that you add up the consumption, the investment, government expenditure, and then export minus export. But there's always another equation that is often ignored, which says that savings are equal to investment. So what that means is that if an economy is not set up to incentivize savings, then lower vehicles of capital, like the one Ivan runs, are set up. And what that means is that when there is an overemphasis on taxation, to put it to an individual perspective, if let's say you are in the high income bracket and you're taxed at 40%, then every time you go to the supermarket, you pay another 18% when you're consuming. And when you drive your car, you pay another 1,500 on each liter of fuel. It means that the amount of money you have left to save is quite limited. And the root cause of that, from a macroeconomic point of view, is the inefficiency around public sector management. So among the things that influence the formation of capital, apart from the tax that has been exhaustively discussed, are the institutional settings. Some of them are as simple as village savings and loan associations, I'll mention them, savings and credit cooperatives. Now, as people learn to put money in these vehicles, the pool of savings in the economy grows. So if you look at the statistics currently, Uganda is at number 67 in terms of the savings ratio, which is hardly ever talked about. Right now it's at 21.7% of GDP, but the average over the last 30 years has been 15%. So the root cause of lack of exit options is partly the lack of the vehicles, which are the VC funds and the PE funds. Now I'm excited to hear what Mr. Tusabe was saying, and that means that there's going to be a tax incentive, a policy incentive to drive capital towards there. But there are some other factors that influence this market. So the supply of funds, I've touched on that. Statutory compliance, Mr. Bwiso has touched on that. So if you're going to exit a vehicle, it's good from the beginning to have compliance to NSSF tax. And when you do that, it gets easier for you to raise capital in the market. The tax policy, in terms of the capital gains tax or the tax rates, they communicate to the market the information. So if you're telling people that we'll tax you at 25% corporate tax and we'll tax you at 30% employment, you're telling the market that if you start a compression that will employ people and pay tax and create more GDP, then we are giving you an incentive. Because, you know, from a policy point of view, you can always signal. So if you signal that if a politician doesn't pay tax, but a doctor pays tax, you're already signaling that you are valuing this person more than the other. In terms of the international factors that influence capital inflow, which eventually influences the exit options, is we are usually ranked in terms of our competitiveness as an economy by the World Economic Forum. So working on those factors like the infrastructure and the markets. So when you take an example of a tax on fuel, you know, the rural economy is connected to the urban economy using transportation. And every time you tax that, you know, that friction that you creates lower economic growth, which makes the economy less attractive to the big PE firms. Because some of them just use numbers. They say, okay, if an economy is not the size of $50 billion, then we're not going to go there. So the whole game about tax policy and reform, for those ones that are in the room from the government, it's about creating economic growth. So every time you have a policy around tax, you really need to ask, is it going to stimulate economic activity? And how do you create incentives for savings to form? Because we've created a lot of regulatory agencies, which is very good for our market. It means that we now have retirement benefits, we have insurance funds, we have the exchange. But what are those policies that can allow more savings to form, which will create more options for the funds, and how do we create competitiveness? I don't know if that helps answer your question. Thanks. In the interest of time.
All right, thank you. Just a bit of follow-up on some of the submissions. Earlier on, NSSF said that yes, real estate is an alternative, but not many of the private market players are exposed to that sector. But also US is saying the private market players are preferring to exit, through other equity funds. So I don't know what response, David, you could have regarding those two.
The issue of not exiting through the USE is quite complex because most of the capital that is invested in the private funds is dealing with early stage growth businesses, which could go to the alternative investment market segment, which is a smaller segment, but it still requires heavy compliance, which I think a lot of our SMEs are not ready to take on, despite the fact that they are ready to take on capital to continue to grow. So the US is not being avoided for any reason but scale, ability to scale at that level. I think when we start to see private equity deals in the consolidation area, where we are creating monopolies, by the way, monopolies are efficient in capital allocation. When we try to create monopolies by consolidating all these small players into more efficient players in terms of capital utilization and wealth generation, then you will see exits of private equity vehicles through the stock exchange. On the issue of rights, I think my colleague Dickson is best placed to discuss the issue of real estate investment being further made available or accessible through trusts or that kind of thing. I don't know if you can speak to the law around that. I'm not really competent.
Okay. Maybe just a quick comment. Number one, we all know that real estate can be quite an illiquid asset. And again, if you're to invest in real estate directly, it requires a lot of managerial skills, you name it. So real estate is a complicated asset, and I think one of the ways that you take away that complexity is through the real estate investment trusts. And the regulations are there, which allow for both development REITs and income REITs, where basically you can transfer your property into this trust and raise capital based on the property that you have in that trust. And just refresh your question specifically on REITs or real estate.
I was saying earlier on, someone mentioned that not many, many people, the pensions, they've invested in real estate, but not as much. But also the likes of David are not so exposed in the real estate sector.
Okay.
Yes.
I think if you look at the bulk of where our pension players are, they're basically in the government treasury space, basically almost 80%. And the thing about the treasuries is that these are very liquid, and to a very large extent they can allow for that liability relative investing, where you basically match your assets to expected liabilities. Now, as to real estate, I think it all boils down to illiquidity. I think the level of illiquidity around real estate is not that encouraging for them to actually get into real estate. But then again, I think with a lot more exposure to real estate investment trusts, which are a lot more liquid, I think then you're likely to see a lot more exposure towards the real estate asset class, but basically indirectly through real estate investment trusts.
One comment on the NSSF. Sorry, one of the tragedies in the monetary system for Uganda, and hear me out on this, is that when we bulk our savings into, let's say, the National Social Security Fund, and then it invests in treasury bonds, I just wanted to explain it a bit for those who are not as technical as you. It means that the NSSF is investing to lend money to the government. Now, when the government pays when it pays the interest due on those bonds, effectively, you, the person who is saving with the NSSF, are being taxed to pay yourself interest. I don't know if I'm making sense. So that's a bit of a tragedy. So one of the reforms should be that we encourage that the portfolio of investments of an NSSF, policymakers have to allow it to allocate, say, 3% or 5% to the Ivans of this world, the private equity firms and the VC firms, because that would mean effectively that the savings are going back to the actual savers. Because what happens is that every time the expenditure of the government is higher than the tax, then they borrow. So if they are borrowing from the savers in NSSF and then taxing the savers of NSSF to pay them interest, it's inefficient because the capital savings in the economy are not going back to create more economic growth unless the bulk of that money goes into capital goods. So I think from a policy reform point of view, to directly impact what we're discussing today, is that what should be on the cards, even for the pension funds, is that the actual savers of this money need to have access to this capital when they have ventures which are regulated, like venture capital funds and private equity funds. And this is the biggest tragedy of the Ugandan financial system, in my view. Thank you.
Thank you. You want to chip in?
Just a quick reaction.
All right.
Just sharing an experience. I think I was in Sri Lanka about 8 or 9 years ago, and what struck me as I was looking at the pension system was that the government pension system, or the statutory pension system, if you look at the objectives, I mean, they clearly state that it's been established to basically provide or finance the state. I mean, they don't even dilly-dally. It's there to provide funding for the state. Well, I didn't say much, but I mean, that was the Sri Lankan experience. But I guess with a lot more, education, I think you can see, when people are a lot more educated, then they should be in a better position to, explore other options.
I think that's the point where we need to revive the discussion on the liberalization of the sector.
No,
but anyway,
I didn't want to mention that, but
but anyway, you have something to add?
Yes.
Quickly, then
yes.
I open up some questions from the audience.
Just quickly to bring that question back to the room. The reason why these tax reforms have been debated on a macro level rather than a micro level is because exactly that. NSSF, PSFU, that is forming the catalytic fund, SACCOs and other investors are not able to put their vehicle in venture capital funds because of inefficient tax regimes that have been taxing returns on investment in a double layer by treating the investors, investees, and the fund vehicles as separate individuals. Yet the fund is just a pass-through between the investors and the investees. So with those laws coming into place, God willing, once assented, and also implementable, because the laws is just a first thing, and then the implementation has to come live. With those things coming in place, then we have NSSF, we have PSFU form local funds, or can invest now in local funds more efficiently than taking the money to public equities in East Africa, or trying to take it to Mauritius, where they are not even allowed to place capital.
So at this point, I would want to invite a few questions from the audience, and also to remind you, it's not every day that you get a chance to speak to Paul and the regulator. You might have to write a letter after a year to get a response. So take advantage of this opportunity and shoot your shot. Do you have any questions? Gen Zs. No questions. All right, I would want to invite the panelists to give us their parting shots. Let me start from Mr. Abubaker. Parting shots and maybe key takeaways from this event.
So for me, first of all, thank you moderator, and thank you, CFA Society. It gives me great pleasure to see young people in this room. As you can see, I have a bit of gray hair. That gives me a lot of hope. And my parting shot is that I really, I'm excited about what I've heard about the tax reforms, because it's been a really big constraint over time. And then my parting shot is that the emphasis we put on tax is the same emphasis we should put on savings and how they are generated and how they are incentivized in order to get to where we want to get. Thank you very much.
Thank you. And I think I've already thanked the CFA Society and the partner organizations for putting together today's event. I think it's been a wonderful and magnificent event. Now, my parting shot would be, we're taking baby steps towards operationalizing the private capital space and, positioning it to better serve the capital needs of Ugandans. So we're just taking baby steps, but what I believe is that we need to look at the entire ecosystem. I think it should be an ecosystem approach where we already look at the taxation bits, but we also look at the legal regulatory framework. We look at the supportive services, from accounting, legal, you name it. So it's important that we have a very broad-based view of the problem at hand and, come up with solutions that address each of those building blocks that are important to fully operationalizing the private capital space in Uganda. I thank you.
Thank you. I also want to take the opportunity to thank the moderator. Thank you for guiding us, and also the audience and the CFA Society for organizing this event. What I learned from the tax policy changes that have come through this year is that it's one of the examples of the challenges that we face as a country, and there are many others that touch on investment. And the people in this room, you're the people that are going to solve these problems. No one is going to fly here to solve them. In other words, if you look at the journey of this conversation around the tax policy reforms, Dickson, David and other team members have been walking this journey, not giving up. So what I encourage members is, whatever challenge there is, you have the ideas, you have the solutions, you bring them on board to Paul, Dickson, or talk to other professionals like myself. Let's have solutions and let's push the policymakers to bring through these solutions, and don't give up. Thank you very much.
Thank you, Mr. Paul.
So I believe the public markets and the private markets work hand in hand, and there should be direct collaboration between the two. If you'd like to see growth in the private markets, I think aligning with the public markets where there's assets under management in the range of 30 trillion that have a lot of potential. Currently, the 11 companies listed on the exchange, the local companies, have a market capitalization of about 12 trillion. We've raised, the companies have raised about 1.3 trillion initial public offers, about 288 billion in bonds issued. Government has listed over 35 trillion in government bonds and treasuries on the exchange. The different market segments play a different role. As David mentioned, we've got the growth enterprise market segment, and this segment is really, the role it plays is for growth companies. In other words, it's more of hand-holding and working hand in hand with the company and with the pension funds and the investors to align and work in a direction that you will probably list or exit off the main market segment. So there's a lot of potential, and I think recently we introduced the USC specialist market, and this is a private market that has both an incubator but also provides capital to companies in a private setting and also a private platform to trade off if one wants to exit. The markets have actually worked. The liquidity might not be as much as one would expect in a developed market, but we've seen growth post-COVID. We've seen some counters rise as high as 100% over the last 3 years, some at 58%. And we've seen a positive trend in the companies paying dividends and good dividend yields, some as high as 17%, 27%. And those figures are available through our licensed stockbrokers if you'd like to read a little more into the investment options available. So the pension funds are keen on investments, but they are tied to public markets. So if those synergies can be aligned, we could see growth in both the private markets and the public markets. I would like to thank the CFA Society for organizing this, and we look forward to continue working together in support of this initiative. Thank you.
All right, thank you. David?
In keeping with the theme of the conference today, it is really about encouraging local private capital formation to drive the agenda or set the agenda for investment in Uganda. And the critical element that is lacking in my mind is skills, and therefore building it around the CFA designation is critical, because to us it represents the global standard of an investment professional around other different professions such as legal, tax, as we have witnessed in this room. So we should use our local reforms, our local policies to encourage local capital to galvanize around investment, and then use that critical mass of skills around that capital to leverage and borrow and bring foreign capital, not the other way around. If we try and set the agenda on foreign capital coming in first before we invest, it just begs confusion. Why should somebody be more interested in Uganda than we are interested in Uganda? Why should somebody be more skilled in Mauritius than we are skilled in Uganda, managing affairs of Uganda? These are some of the things that I find quite annoying, but we have to move on and keep moving on and encouraging each other to develop an environment that can think for itself and act for itself and demand its share of the pie. Thank you.
All right. Thank you very much for your insights. A round of applause for our panelists as they take a photo, and then I don't know what's the next program. A photo moment.